Hey there, welcome to another episode of the Investor Types podcast. I'm your host, Stefan Angelini, and I'm here today to talk about fixed income, or what people might commonly known as cash term deposits. But what people don't know is that this does get a little bit more intrinsic and sexier, the product. And here to talk about sexy, we've got Adam Curtis from Perpetual.
Thank you, Stefan. Glad to be here.
Thanks very much for coming on.
Absolute pleasure.
When it comes to investing, and especially talking about fixed income, it can get quite boring and quite laborious. And I've heard you talk many times about this information and all types of investing, but you've got a way to make your investing sound, different and interesting. How do you do it?
Look, I think it's an exciting asset class, albeit it doesn't get the cachet of other markets. I think that's a shame. It's the biggest of all capital markets. It's the oldest, but it's the most important. And if you understand fixed income, all the other asset classes fall into place. I think the real challenge with fixed income is in its breadth. A lot of investments can sound very similar, but can be very different. The key to understanding fixed income is forget about it as thinking about fixed income. Think about it as loans. Think about it as lending, because that's all fixed income is. Think about the length of the loan you want to make. Think about the quality of the borrower. We call that credit quality. Some people call it tenor. But if you understand those principles of don't lend too long, don't lend to someone that you don't think will pay back, the beauty of fixed income lies in its predictability.
All right. And when you come to the quality of your borrower, you can talk about borrowing money to governments.
Yeah, that's right. There's all sorts of different borrowers out there, and to a degree, the returns in fixed income are commensurate with the type of credit risk or the type of borrower you lend to. Lend to a government, you've got a very low risk of not getting paid back, but conversely, you've got a pretty low yield. Lend to an investment grade company, you get paid a little bit more than lending to a government. Lend to a sub-investment grade company, you can get a return that sounds like equity, but you might not get your money back. So the more credit risk that you take in a portfolio, from lending to a government, to lending to an investment grade company, to lending to someone that doesn't have sort of the balance sheet, the greater the opportunity for returns, but also the greater the opportunity for potentially risks that you're actually seeking to avoid.
100%. And there are risks in lending to different kinds of governments.
Absolutely.
Around the world.
We've seen that a little bit over the last few years. I think one of the most oversubscribed bonds in the last couple of years was the Argentinian government bond that people were just clamouring because of the yields associated with it.
What were they?
Look, I think at that point they were sort of 8, 9, 10% relative to sort of, government bonds in Europe and the US that were paying you effectively nothing. In some cases they were paying you negative yields. But it's interesting to that point, because it's a good point you make, Stefan. That asset now is, I think, trading at about 50 cents in the dollar. So many investors buy an asset based on the sense of I get the promise of a great return, but they may actually find that they're actually getting risks that they don't see until they see, and that's the real challenge with fixed income.
100%. And when people go into the asset class or the space, they go, well, this is a risk-free environment, because they typically associate it with cash and term deposits. To wind it right back, when you look at cash and term deposits, they mainly operate off the make-bill swap rate or the by and large interest rate in the economy. And we've got Australia right now. Why? A lot of Australians love term deposits because if you invest less than $250,000 into a big bank, it's backed by the government. So your money is partly secured there.
Absolutely.
But there are falling interest rates at the moment, so people are sort of clamouring as to what to do. Why do you see interest rates falling?
Look, it's a conundrum. To a degree, I suppose interest rates are falling because, in essence, the Australian economy is not performing necessarily as strongly as our central bank and our governments would like, and they're using fiscal stimulus to try and kick that in. But you make a good point. I think good portfolios, whether it's fixed income or more broadly, have a blend of assets and a blend of different risks. And term deposits can provide part of the solution. But I think in today's climate, if the only asset that you owned in fixed income was a term deposit, well, you're doing yourself out of opportunities, and you're introducing the risk that you're introducing a return that's insufficient to fund the retirement or the investment goals that many people have. So I think good portfolios will hold term deposits. What's the right mix is a function of someone's attitude towards investment horizon and return. The challenge, I think, today is that a lot of fixed income investments have performed particularly well retrospectively because interest rates have fallen. That sort of historical return may not necessarily be replicated if interest rates don't continue to fall, and mathematically they can't continue to fall like they have. So the real challenge in life, like it is in investing, is that what's worked well in the past is unlikely to work well in the future. And that's really important, that you understand what you buy before you necessarily buy it.
And that's so interesting that even though interest rates, term deposit rates are falling, fixed income, that space is still growing dramatically because of that.
It is. And I think this goes back to the original question, Stefan, of understanding fixed income. At Perpetual we've done a fair bit of work with our clients on trying to help them understand it. And it really resonated with me that some of our clients and some of the people that we worked with in our families are big fixed income investors but weren't investing in funds. They're really comfortable with the concept of what we call term deposits. Mm-hmm. Term deposits, you lend to a bank lends to you as a business owner, me as a homeowner, they leverage it up, the benefit for all those extra returns go to shareholders, and the term deposit in essence bears the lowest return for that. I'd look at fixed income as not necessarily lending to a bank, but lending like a bank.
Yep.
And the difference is that you, as the lender of the capital, benefit from the margins similar to the banks, in essence, lending to you and I or other sort of people. Mm-hmm. And I think that's what people need to think about today. In a climate where risk is sort of poorly priced, cash rates are low, government bond yields are low, as investors, we're chasing returns. Mm-hmm. But we can well chase returns at the expense of actually what we're trying to do, which is manage risk. Good fixed income portfolios really provide the total portfolio or the other investments in that portfolio the ability to take risks with greater confidence. Because if you structure your fixed income assets well, you've got the capacity to take risks in asset classes where you're rewarded. Mm-hmm. Equities are about making you money, fixed income is about giving you the confidence to make money. And I think sometimes in today's climate we run the risk of people buying fixed income investments that sound too good to be too true, and they may well find that they actually are.
That's part of the trickiness in the space, isn't it?
It is. And to that end, there are some simple questions investors should be asking themselves. Ask the group that's putting the product in front of them. Look at the offer document. What's the type of borrowers there? How many borrowers? How diversified? Where are you in the capital structure? What's the length of the loan? What's the type of loan? Is it fixed? Is it variable? Is it what they call short duration? These are hard questions, but frankly, they're the most important questions to ask, because once you know those, you'll know exactly how it'll perform. We call it the Fixed Income Toolbox. Happy to send it to you for your clients and listeners at a later point in time. But quality of loan, tenor of loan, subordination of loan, once you answer those questions, you've got a very clear picture of what you're buying.
Yeah, and now, so you at Perpetual manage approximately $25 billion worth of money.
$25 billion, yeah.
Which is, a lot, and that means you've got a lot of assets at your disposal in order to get more access to these companies and who you're lending money to.
Correct.
Your average Joe on the street can really get access to your cash rates and your term deposits.
It's really hard. It's a really good point. I mean, in some regards, the most commonly traded security that people are familiar with are shares. You can trade them on exchanges. Fixed income, to a degree, isn't traded often on exchanges. They're traded effectively what they call OTC, or over the counter. Mm. So the minimum parcel size for most fixed income assets outside of cash and term deposits and things like that are $500,000. And not many investors have just one $500,000 investment to make one loan.
Well, it's because you're lending money.
Correct. And the key risk in fixed income is asymmetric. Make a bad loan and you might not get your money back. So ironically, you actually want to manage risk in fixed income differently to equities. I think you're rewarded for concentration risk in equities. I'd be happy to own a portfolio of 10 or 20 shares. But in fixed income, we would average probably 100 loans. Because if one loan doesn't perform like you expect, you've got 99 other loans kicking in, where the reality is if you've got 5 loans and one goes bad, you could be waiting 20 or 30 years to get your money back on the total portfolio. And that's the risk that investors need to be aware of today. There are plenty of products that are offering people yields of 7, 8%. How can you own fixed income and it be defensive and predictable when cash rates are 75 points and someone's targeting a yield of 8%? There's something wrong there.
Yep. Those kinds of risks that people take, they're just you need to have your numbers right. Yeah, and
Absolutely.
that's why people pay businesses in order to manage that fixed income risk. In terms of how much of a portfolio people normally have into fixed income, you said you love your equity space because you've got the growth there, and that's what you try to focus on. Fixed income does play a certain role in a portfolio, more of an income sort of a role.
It does, and I think like someone's allocation to fixed income is a function of sort of different questions for different people. Sometimes it's their attitude to risk, sometimes it's their capacity to absorb risk. A young investor in accumulation, in my opinion, probably doesn't need a great deal of fixed income. Mm-hmm. They might own some for some liquidity or some optionality that they've got. But their job and our job in the industry is how do we grow their wealth? Mm-hmm. You get to a point in your investment journey where your focus moves from growing wealth to preserving wealth. And I think through that sort of investment journey, potentially your exposure to fixed income can grow. by the nature of your capacity to absorb risks.
Yep.
And there are other investors, statutory bodies like hospitals and health funds, etc., insurance companies that have investment policies that really prescribe them only investing in fixed income to a degree. So really, I think someone's exposure is a function of what they can do and what they want to achieve.
Yeah.
The question I think people need to think is, when they buy fixed income, is it really fixed income, or is it something that's sort of dressed up as fixed income but actually is probably more equity risk?
Yeah, and that's when you start to lose all of your money. And we typically associate fixed income with something that you can sell down in case there's a rainy day and the equity markets start to fall off.
Yep.
You expect your fixed income exposure to sort of relatively remain unchanged, hopefully, still provide you an income.
Yep.
And when we look at a bucket approach with clients, it's all right, well, when do you need your money, or when do you need to draw down on your money?
I think that's the perfect way to think about it.
Yeah, when you've got a fixed income, when you've got a portfolio of assets, whether it's in your own name, or when do you need access to those money, and do you need them to pay you an income? So some people that might be focusing on an early retirement, retiring at 50 and not looking at their super fund.
Yep.
Whereas with people that are using their super fund, as they do start to approach the 60, 65, looking towards retiring, then they really need to start allocating maybe more money towards these fixed income spaces, because you don't have that risk, that up and down. You do get paid your income.
Potentially, yeah. I think that's the beauty of fixed income. Like, as investors, we don't know what the price of Woolworths will be in 3 years, but we know Woolworths will be here in 3 years. So from a lending perspective, if you're happy to invest with them for 3 years on a loan, and you're happy that you've got the investment horizon to invest for 3 years, the predictability of the return is very high. The predictability of the capital return is almost guaranteed. The key risk in fixed income is, don't invest in something longer than you think you've got the capacity to own it, and effectively don't invest in fixed income if you've got the expectation of equity-like returns. To me, fixed income is all about giving you predictability to take the risks in parts of your portfolio where you're better rewarded for risk. And that's challenging in today's climate, with low yields.
And where these companies, these bigger companies, talk about Woolworths, where they go out to the market and they ask for money to borrow from you, and they might call it a hybrid. And then that might be an asset class that's an enhanced yield, whereas it's not your typical fixed income product, but they've got different levels of their debt structure, which gives you that different confidence of getting your money back.
Absolutely. Typically in markets we refer to that as the capital structure, and depending on the companies, there by and large are 4 layers to most companies' capital structure, and the top of that capital structure is effectively senior. Often it's secured. Then you might move into subordinated debt, and then finally you might move into what's called the hybrid tranche, and then finally equity. All things being equal, every time you move down the capital structure, you get a greater return, but you also rank lower. And so I think that's really important, that in some regards, that investors in fixed income, they get paid their coupons before shareholders get paid their dividend. In the event of companies getting into problem, then shareholders lose their equity before bondholders contribute equity, and it, in essence, works through the capital structure. So stay short, stay at the top of the capital structure. Yes, returns might be a little bit lower, but the predictability of the asset class is in that space.
And you talked about, especially with these asset classes, writing it out and being able to dedicate to that period of time, whether it be 3 years, 5 years, 7 years. Typically with these, they are liquid, so you can trade in and out of them if you do need the money.
Absolutely.
However, if the capital price that you do pay for these does go down, then you're going to be losing money.
Potentially. I think the only risk in fixed income is you sell something in an environment where risk is differently priced than you bought it. Outside of that, if you're in the investment in broad terms equivalent to the length of the loans or the average life of the loans, then the risk of that capital volatility is pretty minimal. But you can see scenarios where if you bought a fixed income investment the day before the credit crisis in the GFC and tried to sell it in the midst of the credit crisis, you might sell it at 80 cents in the dollar. But conversely, for the investors that bought it at 80 cents in the dollar, 2 years later they were getting 100 cents in the dollar. So the real risk in fixed income is, don't sell it at a point where you're not happy with the price, or don't buy assets that trade at that price. Quality assets always are liquid, and quality assets always has visibility, and that's what it's all about. If you keep it short and keep it high quality, other investors want that asset because they want visibility and predictability. The real risk in some regards is sometimes that's hidden. The average length of the loan sometimes can be hidden. The type of subordination you referred to before can be hidden. bank hybrids can play a role in a portfolio, but why not own the bank shares? Because that's where you get the upside. And own the senior debt for the predictability. And Perpetual, we'd prefer to own equity risk in banks and senior debt in banks than getting typically lost in the capital structure where we feel that we own the equity risk but we don't necessarily get the equity return in that space. Those things are dynamic and they can change.
So this fixed income space, as you really start to drill down into it, there's a lot more to it than the average eye can see. And that's when you're involved in the industry, you really get to see that.
It's really important. You look through every advisor's APL or a list of investments that are available to direct shareholders, even in the listed markets now. And there are products that sound awfully similar, Stefan. They sound awfully similar to me, but I tell you what, they can perform awfully differently in different environments. And I think the most important thing that I'd counsel investors, if they're not sure, don't do it. And if they're not sure, seek advice. Talk to their professional advisors, talk to fund managers, and if they don't like the answers they're getting, then they should steer clear. But like anything, if you understand what's underneath the bonnet, you'll have a pretty good understanding of how it'll perform. In today's environment, I would caution investors from buying stories about returns, but I'd be working with companies that focus on risk, because it's really important to manage risk and accept the returns that come from it, rather than design returns and then accept the risk that's commensurate with it.
And through periods of greater returns, obviously the risk is lower, it seems lower, but as the market starts to turn, the risk becomes a lot higher. And you spoke before about during the GFC, companies or these hybrids losing 20% of their market value.
Even more in some cases.
Have you seen any of the horror stories where some of these companies have gone bankrupt, where people have lent these monies or borrowed monies that they thought was secure?
I think there's examples of that all the time. It's not examples that we have a lot of at Perpetual, because we're not in that space. We're in the space of finding quality businesses and lending to quality businesses. So those type of assets happen in the market, but they're not sort of consistent in stories in our portfolios. But there's plenty of examples of investors that have made direct investments in high yield companies that have got cents in the dollar in recent years. Mackay Sugar is a one that comes to mind. But there are companies that were investment grade companies years ago that don't exist. I mean, Lehman Brothers is a perfect example. I think it was an A-rated investment grade investment bank of global reach, and some people lost effectively all their money in that. In senior debt in Lehman's, I think you were getting 75 cents in the dollar. So even though the company bankrupted and equity holders lost everything, hybrid investors lost everything, people who were at the top of the capital structure still recovered, I think, about 80 cents in the dollar.
And there's your risk mitigation, that if you are relying on to keep your money throughout your retirement or things like that, these fixed income exposures, you still get some money back, hopefully, at the end of the day, if you're higher up the risk change.
Absolutely. It's a trade-off with everything. At the end of the day, there's no free lunch in investing. And I think that's the key guide. What are your expectations of fixed income? And if you come to any investment decision with clarity of what are the attributes I want from this, and I'd encourage investors to think that the role of fixed income is get your money back, have predictability, get an income stream that's sort of cash or better than cash through the cycle. And when you find those attributes, you'll get a return that we think is probably about 2% above cash. Now, 2% above cash is 3% today.
Doesn't sound great, does it?
It doesn't, but it's 2% above cash. But I think if people are thinking about getting 8 or 10% from fixed income, they're not buying fixed income.
No.
And that story will change, and we've seen that in previous cycles. Going into the GFC, we sort of saw that in other markets. We saw that in what were credit markets, where investors were unhappy with the returns and they levered the returns. They structured the returns, and we came up with all those products that were called CDOs and CPDOs and CLOs, and they're all credit rated. Many investors got burnt chasing a few extra bits. In pursuit of higher returns, they lost sight of the risk. And that's why I would encourage people to seek professional advice or work with professional managers. At the end of the day, if professional managers aren't generating better returns, better risk-adjusted returns than investors can do themselves, there's no reason for people to use them. So the ultimate alignment is find managers that can show you the proof of the skill and the value that comes from their active management.
100%. And this is where we get on to, what kind of investor goes into these kinds of investments. Obviously, you've got different spectrums. So let's start down from the beginning, cash and term deposits. What kind of investor would be investing in cash and term deposits?
Look, I think, everyone has a role for liquidity, and for me, cash and, to a degree, short-dated term deposits are really a liquidity bucket. You might have that in terms of meeting immediate cash flows. You might have that if you've got particular saving goals in mind. So there might be a young investor that's saving up to build, a portfolio of cash for a house investment. Cash and term deposits make sense for them. A retired investor that's got cash flows to meet for their ongoing lifestyle expenses, keep it short, keep it liquid. But I think outside of that, much more money in cash and short-dated term deposits is underselling the potential returns you can get from other parts of your portfolio.
That's right, and potentially getting beaten by inflation.
Correct, at the moment. Well, I think at the moment, inflation came out yesterday, I think at 0.8 in the quarter. Well, that's the cash rate done.
Yeah,
in 3 months.
So, yeah, and then you go further up the risk profile, where you're targeting these hybrids or lending to good governments or to good businesses.
Yep.
What kind of investor would lend money to these kinds of?
Again, I think they form a part of any sort of fixed income portfolio, but the type of investors that might buy credit, and credit I'd say is lending to non-governments, and they can still be very high credit quality, are investors that are trying to get something better than cash, but are also aware to accept that there is some small volatility in the pursuit of that high return. So that would be what I'd call credit enhanced or cash plus type investing. Typically I'd expect that to achieve investors somewhere like 100 points to 200 points above cash, or 1 to 2% above cash, so long as they've got a 2 to 3 year horizon. I think that's pretty indicative of a high quality investment grade portfolio. If you're wanting a return above sort of 2% above cash, then you're going to start moving down the capital structure. You're going to be into subordinated debt, or you're going to be into longer dated debt. Nothing wrong with that, but understand that the greater the credit risk in your fixed income, or the greater the tenor of the loan that you make in your fixed income, you're going to get paid more for taking that risk, but you also introduce higher correlation. With equity, you also introduce higher volatility, which may in fact be exactly the things that you're trying to reduce.
That's right. So these people need to be comfortable with their money going up and down.
Correct.
With them potentially not getting their capital back, while they might get rewarded with higher income rates.
Yes.
That capital piece that they so dearly rely upon is at risk.
Exactly, and the challenge, the same problem would exist if people traded and valued term deposits on a daily basis.
Yeah.
At the end of the day, a term deposit is a loan, and you think of that loan over 3 years, but you put your money away for 3 years and you pull it back in 3 years. Fixed income funds, in essence, might invest for 3 years, but they're trading every day, and so the volatility is not necessarily different than a term deposit, it's just valued differently. But if you traded your term deposit every day, today we went into a bank and we set up a 3 year term deposit at 2%, and tomorrow that bank was offering a 3% term deposit for the same tenor, you tried to sell your 2% loan, who's going to buy it? No one's going to buy it. But conversely, if you'd locked in 2% and the bank's offering 1% the next day, you're in the money. And that's really the challenge with fixed income. Everything can fit on these axes, Stefan, of what people call credit risk and duration risk. Some securities have no credit risk and lots of duration. That's like a US government bond. The risk is minimal that you lose money from the credit, but the interest rate risk is high because you've locked in 30 years worth of interest rates, and who knows what's going to happen in 30 years. Conversely, you can have a short duration loan that's got no interest rate risk, but you might be lending to a sub-investment grade company and you've got a lot of credit risk. You don't really know. And if you don't know, as I said, find out, ask the questions, and if you're not sure what the questions are, work with guys like you or Perpetual to find out.
Yeah, exactly right. And there you go. So fixed income, it's a very in-depth space. Thanks so much for coming on and having a chat.
It's been a pleasure.
I reckon this conversation has opened up a lot of people's eyes to what the fixed income space is about. It's mainly about time and the risk you want to take with your money.
It is. And it can be a really exciting asset class. Get it right, and as I said, the other things in your portfolio matter less by the nature of you've got the predictability and the certainty that this asset class can provide. And as I said, I'd really caution against people chasing yield in an environment where risk is a little poorly priced, yields are low, that you want to think a little bit about what you expect from the asset class, accept the attributes rather than pursue a return, because pursuing the return may well introduce risks that you're not expecting.
100%. Mate, thank you so much for
coming on. Absolute pleasure. Thanks for having me here.
Hope you really enjoyed this episode. If you've got any more questions, feel free to leave a comment below. Other than that, we'll see you soon, mate. Thanks a lot.
Cheers,
really
Stefan.
appreciate it.
My pleasure.
Thanks for your time.
Thank you.